Hello, everyone. Welcome to today's webinar. Pleased to have you. I don't think it's going to come as any surprise to anyone that the topic of discussion is COVID-19 again. Obviously, the biggest event to hit the economy and the real estate industry in particular in our lifetimes. In particular, today we want to talk about the policy response to COVID-19. There's, as everyone knows, there's been some immense bills passed by Congress. There's been a lot of activity at the Fed. There's a lot of changes in regulation, and there's a lot of associated tax issues. We want to address all these things, and we were very lucky to have the cooperation of the Real Estate Roundtable, which has lent us, a good part of their brain trust for today's webinar. So joining me today to talk about all these issues, we have Dwayne Desiderio, who's Senior Vice President and Counsel at the Roundtable, Ryan McCormick, who's Senior Vice President and Counsel at the Roundtable, and Clifton Rogers, who many of you may know better as Chip Rogers, Senior Vice President at the Real Estate Roundtable. Now, before we get into the actual webinar and the content, just a few details on logistics. First of all, you should be able to see on your screen a facility to enter questions. Please feel free to enter questions at any time. As the different speakers go through their parts, I'll throw in a few questions along the way. We'll also have some time, hopefully, at the end for more Q&A. So as you think of questions, please enter them, and we'll keep track of those and try to get to as many as we can. Also, just to preempt the most common question, yes, there will be a replay of this webinar available. It should be up on the PREA website shortly after the end of the webinar. Give us a couple hours anyways to get things processed and put up, but it should be up shortly. And also, if you would like a copy of the slides, you should see on your screen now, so underneath the questions box, there should be a tab marked Event Resources. If you click on that, that will allow you to download a PDF of the slides. And if you forget and you want to do it later, if you go to the replay of the webinar, that Event Resources tab will also be there as well. So you can download the PDF later on. Now, just before we get to the real details, let me just do a very kind of brief overview of things here, just with a very broad brush, and then we'll fill in the details later when the actual experts speak. So if you look at the policy response in terms of the stimulus packages that have been passed by Congress over the last little while, they're usually broken up into phases. Phase one, the bill was signed into law on March 6th, which is almost exactly 2 months ago, although it sort of seems like a lifetime ago now. And at the time, it seemed like a lot of money, $8.3 billion, mostly for the public health response. Shortly thereafter, you had what they call phase two on March 10th, $192 billion. Most of that went to funding for the states for unemployment insurance, but also included funding for expanded sick and medical leave as well as nutrition programs. Then phase three is, of course, the big one. That's the CARES Act, about $2.2 trillion. That included things like the Payroll Protection Program, which we'll be discussing in more detail in a few minutes, as well as the expanded unemployment insurance, the extra $600 a week that people can get from the federal government, the direct payments to individuals, specific industries got money, there's an expansion of small business programs, and there's an allocation of money to the Fed for their various credit facilities. And we'll also be discussing in more detail these programs from the Fed in a few minutes. The next phase, which people are kind of calling phase 3.5, it's not quite 4 yet, I guess, was basically additional funding for parts of the CARES Act. As everyone knows, the PPP, the Payroll Protection Program, ran out of money very quickly. So this allocated extra cash to that as well as to a few other programs. Now, phase four, will there be a phase four? It's probably likely to be some kind of phase four, but what's going to be in it, we don't know yet, but I hope that our experts will be able to provide some insights in terms of what to expect coming next from Congress. I will note that, obviously, the CARES Act is hundreds of pages in it. They can't put all the details about it in a few bullet points. There's a lot of details left out there, especially details about some of the various tax issues that arise because of the legislation that's been passed. And Ryan later on in the webinar will talking more specifically about some of the tax implications. Now, you note capital was allocated to the Fed for some facilities they have started, and to my mind, you can kind of break the Fed's response into sort of three groups. First group is just the standard monetary response. Historically, what central banks have always done. They lowered interest rates in response, so the target Fed funds rate has a lower bound of 0 now. The next group are the financial crisis era tools, quantitative easing, as well as a reviving of the TALF program. Those, the way the Fed talks about them, are really about providing liquidity to the markets and really keeping the markets functioning as they're supposed to. The new programs, however, that are new in this crisis versus last crisis, these really expand what the Fed is doing and more directly involve lending to the private sector. So you've got the Fed able to purchase investment-grade corporate bonds up to $750 billion. You have the Main Street lending program for smaller businesses, and you have credit facilities for municipals and commercial paper and a few other things as well. And a little bit later in the webinar, Chip's going to be going through some of these things in a little bit more detail in terms of how they actually work and what the implications are for real estate in particular. Now, with that as a little bit of a setup, I do want to turn it over to Dwayne now to talk a little bit more about the Payroll Protection Program. Before I do turn it over to you, Dwayne, though, I will note that aside from being one of the country's leading experts in real estate policy, he also happens to have a birthday today. So I am not going to lead a virtual sing-along of happy birthday to you, but please know as you speak that I'm singing on the inside. And with that, Dwayne, please take it away.
Thank you, Greg, and thanks for the kind wishes. Cinco de Mayo has always been a fun birthday to have, and trust me, I will be celebrating Coronas with limes tonight with my family, so that's the Corona that we're going to be using today. Thanks for the opportunity. Happy to speak. I'm going to give a 6 to 7 minute overview, as Greg had mentioned, with regard to the Paycheck Protection Program, and also briefly address some issues that arose in the CARES Act with regard to residential eviction protections for tenants and forbearance questions for residential property owners. I'm going to fast forward over a few slides that folks might want to go back and look to. Some detail in there about a little bit more detail on the lead up that Greg talked about in terms of the various phases of legislation we've seen. So I've just jumped ahead now to the Paycheck Protection Program slide. This is the main program that I think has received a fair amount of play thus far from the CARES Act and its implementation, that is designed to address and help small businesses meet their payroll. $649 billion total appropriations thus far in little over a month. It's unprecedented, as long as I've been working in Washington, D.C., that we'd see such a large program authorized and rolled out so quickly. We will talk about the rollout of the program a little bit. I think it's fair to say that there have been questions and the rollout has been somewhat troubled. Just bear in mind, though, and some perspective on how quickly all of this has been rolled out. There's also constantly updated and renewed guidance and information we get from this program that is administered by the Small Business Administration and the Treasury. So even some of the information that we provided to prepare for this webinar as of a day and a half ago is probably a bit out of date relative to new guidance and reports that only came out yesterday. But suffice it to say that in a recent report that SBA had issued through April 16th anyway, a large number of loan dollars have been given out or committed. The construction sector has been the largest beneficiary, at least as of this last report of the program. You'll see on this slide that the retail trade has gotten some money, technical services, professional services have gotten money, healthcare and social assistance money, as well as real estate. Real estate has been at least dispersed some money under this program. We'll talk just shortly about some of the questions surrounding real estate's eligibility for the program that have come to the fore recently. But I'd recommend that folks click on that link to see what sectors are getting money and how much money is going to each sector. On RER's website, www.rer.org, we have a bunch of resources on all of the issues that we will talk about today, but in particular, an 8-point plan that we've put forth to policymakers to improve the Paycheck Protection Program, both administratively and legislatively. I think it's fair to say that in terms of what we've seen with the rollout of the program, that the language that Congress originally enacted in the CARES Act to authorize the program, the kinds of uses for which PPP loans could be used, and who would be eligible for PPP loans was rather broad. But we've seen somewhat of a clawback in the implementation of the program in subsequent weeks by Treasury and SBA that have taken a very narrow and constricted approach to some of these issues that Congress had broadly authorized. So moving to the next slide, I'd like to talk about 3 areas where we have viewed Congress as providing broad authorization, but then subsequent regulatory interpretations by the agencies have clawed back a little bit. So just with regard to the eligible scope of businesses, who qualifies for a PPP loan, the CARES Act states that in addition to typical small businesses that typically qualify under the SBA's regular programs, a big expansion was made here toward businesses that have 500 employees or less. So a broad expansion of eligible businesses that can qualify for PPP loans. Then in subsequent regulations, particularly an interim final rule that SBA issued back on April 2, SBA then imported a regulation that it uses for its regular loan programs to start carving out some businesses and some types of businesses. It has caused some consternation for the real estate sector. An ineligibility regulation that I cited, 13 CFR 120.110, was cited by the SBA in its interim final rule of April 2. And among that regulation, it lists about 18 or so ineligible types of businesses. Passive real estate businesses are on that list. Please take a note and look at the particular regulation I cited in this slide, where under its regular loan programs that SBA has now endeavored to import here, that passive businesses owned by developers and landlords that do not actively use or occupy assets acquired or improved with the loan proceeds would be ineligible for PPP loans. We read the very face of this regulation that SBA tries to import here to note that PPP loans are not used to acquire or renovate the asset at issue. PPP loans are expressly used for the purpose of primarily paying for payroll and some other uses that we'll talk about. So when we saw this ineligibility rule, we acknowledged that it created a little bit of confusion, but we did not think this ineligibility regulation would apply to preclude real estate leasing companies from accessing the program, assuming that they were 500 employees or less. An SBA District Council interpretation over the weekend has since come out that has unfortunately taken a very narrow view of the program. Only one council interpretation has come out. This has not come out from DC headquarters for Treasury or SBA, but we do note this narrow district council interpretation that states real estate leasing businesses are not eligible for PPP loans. We have taken this up to policymakers and regulators to try to clarify this, but put this on the list, something that we are very closely following. Another example of what we see as a broad legislative authorization, but then a clawback in terms of implementation, concerns the uses for which PPP loans could be put in terms of its proceeds. The CARES Act states that PPP loans are eligible for payroll, as well as paying the workers' benefits, but also for other allowable uses such as using the loans to pay mortgage interest, pay rent, pay utilities, and other debt obligations. In subsequent SBA and Treasury interpretations, they have since stated that no more than 25% of PPP loan proceeds can be used for non-payroll purposes. So they are trying to primarily gear this to recognize the name of the program. The loan is primarily used for payroll purposes. So that's another area where we've seen a clawback insofar as its allowable uses. And then let's also just briefly talk about the affiliation rules. So another example here, under the regular SBA's implementation of its ordinary loan programs, to determine what is a small business in terms of size, there is a complex set of rules with regard to how do you determine affiliates of an organization. Here, in the context of PPP, to reach the critical 500 employee threshold, does an entity aggregate and add up employees across affiliates? Or does it just look at the employees at a single location? Here for the PPP in the statute, these affiliation rules were waived for the hotel and restaurant sector for NAICS Code 72. So that would mean that hotels and restaurants can look at a per location, at least under the vision that we read in the statute, could look at a per location approach to determine whether or not the 500 employee threshold has been reached. However, with regard to subsequent media reports where some brand named restaurant and hotel chains did qualify because they did not have to aggregate employees, the Treasury has since come out with a subsequent FAQ, referenced as FAQ 31, which states that PPP borrowers that might have access to capital markets and other means of liquidity should not be accessing the program even if they fit within these employee caps. So another example here of what we've seen as a broad authorization of the program, but then a clawback of the agencies. I'm quickly going to now jump to the next slide, but I think we'll save some of this stuff for general Q&A because I want to be responsive and respectful of Chip's and Ryan's time, but also warrants a little bit of follow-up discussion with regard to the issues in the CARES Act that provide eviction protections for residential tenants, not for commercial tenants, but for residential tenants, and some more limited forbearance protections where owners of residential single-family and multifamily properties do get some limited protections to forbear on mortgage payments for a period of time. So I'm hoping we can get to these, but at this point, Greg, let me hand the baton back to you so you can then pass it over to Chip, who's going to talk about Main Street lending and some other facilities. Thank you.
I'm sorry, I was mute. Thank you very much, Dwayne. Before we go to Chip, let me just ask a couple of questions. First of all, a question that's come in from the audience about the payroll protection program. Basically, wanting to know the difference, between payroll versus benefits. So, do benefits count as payroll or non-payroll in terms of determining that 25% that can be non-payroll?
Thank you. Benefits count as payroll. The statute is clear in this regard, as have been subsequent regulatory interpretations. So here we're talking things about healthcare insurance benefits, retirement payments, pension plan payments, severance packages. There is a long list of what the statute identifies in its definition for payroll and benefits to discuss what some of those items are. The non-payroll items that are subject to the 25% cap are payments of mortgage interest, payment of rent, and payment of utility bills.
Okay, thanks very much. And let me ask you a question I have, and perhaps this is less a policy question and more a question about sort of the types of things you're hearing from roundtable members. Obviously, the PPP, even if it's not directly applicable to real estate companies, it can help the tenants at least survive through a certain period of time, which is ultimately good for the landlords. Are there any ways that you have heard of or you can think of that property owners can help their tenants take advantage of the payroll protection program?
Well, we do know that there is a fair amount of coordination, of course, between our members who are the owners and managers of buildings working with their tenants. There has been a fair amount of tenant outreach, certainly, to make sure that they know that their tenants are eligible to apply for and qualify for the program. But certainly, without a doubt, you're correct. The way that this has certainly become more focused is that from the perspective of the real estate community, particularly perhaps some of the larger, more national and institutional real estate owners that our organizations respectively represent and their investors, this program is primarily geared to help smaller tenants cover their payroll with a modicum of assistance that might be used by that business tenant to pay rent. But true to the name of the program, it is the Paycheck Protection Program. It is primarily designed for a tenant to keep its workforce in place at salary and benefit levels that existed prior to the pandemic hitting us all.
So there may be some benefit in larger property owners at least helping provide information to their smaller tenants that might be able to take advantage of this.
Certainly, and we have heard that has definitely been the case.
Well, thanks very much, Dwayne. Let me turn it over to Chip now. Chip, do you want to take over and talk a little bit about some of the new credit facilities and other programs that are going on at the Fed?
Chip, you there? Sorry, I was talking very eloquently on mute. Anyway, thank you very much, Greg, and I appreciate the introduction, and I enjoyed Dwayne's take on the PPP program. I'll try to shed light a little bit on the massive Federal Reserve facilities there. The CARES Act allocated $454 billion of money to various loan and loan guarantee programs in support of programs or facilities established by the Federal Reserve. This is far more, I think it's interesting to know, is far more done far faster and far more in terms of dollars than the post 9/11 packages or the 2008 packages. The total amount of money can be theoretically levered by the Federal Reserve to support $4.5 trillion in credit facilities. So this is sort of, I don't know how many people are historians in the group here, but Walter Bagehot, who is a longtime editor of The Economist, wrote a book many years ago called Lombard Street, The Description of the Money Market, which has sort of become a Bible of sorts. And he said, to avert panic, central banks should lend early and freely without limit to solvent firms against good collateral. Fed Chairman Ben Bernanke claimed that he was channeling Bagehot in the 2008 response, and Milton Friedman described this as helicopter drops of money. I think Jay Powell is certainly using these notes in addressing the current crisis. So there are 9 facilities that have been established so far. I think the ones that we've been looking at, and it's sort of across the board, everything from commercial paper, primary dealers, money market mutual funds, primary market corporate credit, secondary market corporate credit. So that those two could theoretically apply to some real estate firms. The TALF, the Term Asset Backed Securities Loan Facility, very important for us. Originally stood up in 08 and 09. And I'll talk more about that in a few minutes. PPP, we talked about, the Paycheck Protection Program. Main Street Program, which is yet to be officially opened, but they've put out some term sheets and FAQs. And then the Municipal Liquidity Facility, which is intended to support state and local governments. So not all of these are up and running yet, but importantly, I think the scope of this puts a lot of money back into the overall economy. In terms of real estate's play in these, I think we're heartened, I guess, by the initial use of the TALF, which was intended in 2008 to just do short-term loans like credit card loans and automobile loans. They were later expanded with a little help from us to include CMBS, and they started just taking CMBS legacy agency commercial mortgage-backed securities, and they've now expanded that to include AAA rated tranches of outstanding non-agency CMBS and certain mortgage loans. So that's a positive step. We've recommended that the TALF be expanded further to include a full range of investment grade, new issuance, and legacy non-agency CMBS. So investment grade agency credit risk transfer securities, legacy and new issuance single asset, single borrower CMBS, commercial real estate collateralized loan obligations, and commercial real estate first mortgage loans, which are highly rated by the NAIC. So we hope that the Federal Reserve will consider expanding their accepted collateral. I think some people are even advocating taking non-investment grade securities, but we think it's important for them to start doing new issuance as well to stimulate additional issuance in the program. Additional issuance for new CMBS. In terms of let's just go to the next one here. On the Main Street lending program, this program has been established. It is not yet open for business. It initially uses funding from the CARES Act to provide $75 billion in equity to the Main Street facility so they can purchase up to $600 billion in loans. The banks will be the originators, and they will take a 5% strip of the loans, selling the remaining 95% to the Main Street facility. So it's a pari passu, sort of like a Fannie Mae DUS program. The banks will be responsible for underwriting the loans and originating them. And so they're going to have a lot of latitude. Now, we've had some concerns about this program and whether or not there's still questions about whether or not real estate and certain real estate ownership structures are going to be eligible to use the program. We're concerned about some of the underwriting, leverage limitations, and loan sizes, and we raised these objections in a comment letter to the Treasury and the Federal Reserve recently. We think that banks should be granted greater discretion in assessing credit worthiness across industries with regard to individual borrower circumstances. We also think it's important for the distributions to be, the restrictions on distributions to be lifted so that REITs and other pass-through entities are eligible to use this. There's still some debate about whether or not they actually can, given the current language. So we're actively looking into that and are awaiting the actual guidance to come out on the program. The loan terms, as proposed, we think are too short to accommodate commercial real estate borrowers in many cases. So we suggested that the programs permit lenders and borrowers to agree to terms of at least 6 years to better accommodate commercial real estate loans. And then using the rate index, the benchmark, they've initially required, and they've come around on this, that most of these loans be structured with SOFR, the new replacement benchmark for LIBOR. However, a lot of banks are not yet equipped to deal with SOFR, even though LIBOR is going away. And so they've made an accommodation to use LIBOR where possible as a fallback provision. And then we think the program should be extended to the end of the year versus just September 30, 2020. So I think Treasury has put out additional guidance since, and we're going to continue to work with them to try to make the program useful for commercial real estate, and we can talk more about this in in the Q&A section. Also, I think it's important to note, Dwayne touched on this, is the regulatory forbearance that has been put out, which we think is very significant. And from talking to many bankers out there, it appears that that a lot of this is being followed. So on April 7th, a revised interagency statement on loan modifications by financial institutions was put out, which encourages financial institutions to work constructively with borrowers affected by the COVID-19 crisis. They won't criticize institutions for prudent loan modifications, and they view prudent loan modification programs as positive actions that can effectively manage or mitigate adverse impacts of the crisis. And it also clarifies the interaction between the interagency statement and the optional temporary relief provided in Section 4013 of the CARES Act, which was involved some additional forbearance as well. I also want to mention, and I guess I should be advancing these slides, sorry. I think Ryan is going to talk about the REMIC forbearance, but I wanted to talk a little bit about pandemic risk also, and then I'll turn it over to Ryan. There's been a lot of talk about gaps in the current business interruption insurance policies that don't cover pandemic risk related to current claims that are in the process. We're working to try to develop a program that would potentially address retrospectively the current gaps in coverage, but would most importantly, going forward, provide a federal business interruption insurance program that would help in the chance that there's a reoccurrence of a pandemic or a government-ordered shutdown. So and part of this effort would involve the next phase involving additional liquidity measures to put American workplaces in a position to reopen and rehire. And finally, I'll mention that we have a working group within the, these are a couple examples of current legislation, and then we have a working group working to restart the economy, and a building reentry working group that's meeting weekly to look at everything from liability to best practices to support building reentry. I think I may have gone on a little too long, but I'll with that I'll turn it back to Greg.
Thanks very much, Chip. Just before we move on, a couple of questions, in particular about the Main Street lending program. I mean, you noted that there are some aspects of it that are unfriendly to real estate. I guess you could say that you guys are sort of working on. Dwayne had mentioned with the payroll protection that real estate is pretty much explicitly excluded. Is real estate explicitly excluded from Main Street lending program now, or it is officially eligible still, correct?
No, it is not specifically excluded, but we've been trying to recraft the program so that it's more accommodating for real estate. And it depends on the type of real estate operating business that's applying. We think it will work for certain real estate firms and or management firms. But there are obvious issues with affiliation and potentially with distribution. So we're looking, I guess, so we're working sort of in two front. We're looking to sort of figure out what works and what doesn't with the program, how to make this adaptable for real estate. But we're also looking forward to additional liquidity measures that will both help real estate and help reconnect the rent obligation chain, as it will, to potentially permit tenants to pay rent and to restore liquidity in the marketplace.
Right. And do you have any clarity on when the Main Street program might actually start? I mean, I know the term sheet's up in the Fed website, but it seems to change every couple of days as they fine tune it. Any idea when this might actually start?
So they've indicated that it would start in early May. We're now on, the first week of May, really. So I would think by next week we'll see something out there. And we'll be working on trying to get an analysis of that out when it comes out.
Great, thanks very much. And with that, I think as I mentioned at the beginning, something that maybe doesn't get as much media play in the headlines, it doesn't fill up the lower third of CNN broadcasts, is tax issues. But there's some exceedingly important tax issues that have come up as this legislation's been passed. Ryan, do you want to walk us through some of the key points of this?
Absolutely. Thanks, Greg. And it's always kind of interesting talking about tax with a pension-focused audience, because the profile of the pension fund investor is so different or is, in many ways different from other real estate investors, typically, being largely tax exempt and faces a different set of issues directly in terms of things like unrelated business taxable income. But I do know that the underlying business equally impacts, the pension fund investor, just like it does any other real estate investor. So want to hit on all the big tax policy issues here. I thought I'd briefly just kind of break this up to a few topics. One would be kind of the actions that have been taken to date in phases 1 through 3 of the coronavirus response and the regulatory actions that have been taken on the tax side. Then talk just briefly on, make some observations and implications of those for real estate. And then lastly, talk a little bit about going forward, what we see as the big real estate issues and priorities for real estate investors, real estate assets, properties, and implications for the industry on the tax side. So on the first piece, what's been done up to now, I kind of think about it in 3 main buckets. And the first and largest is really there's been extensive cash flow focused tax relief. And here the emphasis is not on encouraging any kind of specific new activity or stimulating development or construction. It's really about providing relief to taxpayers who are forced to be inactive due to government orders and the general state of affairs right now in the economy. So that has come largely in the form of about half of that has been directly in the form of recovery rebates to individuals. So in the main coronavirus bill, the CARES Act had about $600 billion in tax relief. About half of that was in this one provision, which was essentially rebate checks for individuals and families up to a total of $3,900, and that was about $300 billion of what was included. But also, in addition to that main provision, there were a number of there's been a number of tax payment extensions and deferrals of taxation for individuals and for businesses, including real estate businesses. And all of those have really been aimed at trying to increase and improve the liquidity of individuals and businesses so that they can pay their obligations and stay afloat during this period of economic inactivity. So that kind of thing includes an extension of income tax deadlines, estate tax, estimated tax payments, pushing all of those out right now to July 15th from any time they would have otherwise occurred between beginning of April and the middle of July. They also offered taxpayers the ability to defer employment taxes so that any employment taxes that would otherwise be due by a business in 2020 can be pushed out for a couple of years. And that's basically like a interest-free loan to businesses, and the dollar numbers associated with that are significant, about $350 billion just in the deferral of employment taxes. Of course, that money comes back in 2021 and 2022, so it's more a matter of generating fiscal relief for businesses currently. And then one that's particularly important to real estate is tax refunds for businesses through the amendment of prior tax returns. So this has been done a number of different ways, but the basic idea here is to allow for people to go back in time and amend prior returns, sometimes going all the way back to 2013, and basically file for refunds with respect to prior years by generally by carrying back losses. So if a real estate business had a loss in 2018, 2019, 2020, all of those can be now carried back in time by 5 years and generate significant refunds for the businesses. So that's a significant change. And then we were successful in getting the IRS to add some additional guidance, which basically allows partnerships, and half of the partnerships in the country are real estate partnerships, allows partnerships to file amended tax returns because they're not generally able to do so under the new audit rules that were adopted back in 2015. But in order for that carry back the losses to have any help for real estate, it was really important that the rules be modified there to temporarily allow real estate partnerships to file amended returns. So that was important. Another big bucket here is added flexibility for transactions. We've been particularly focused on like-kind exchanges. Essentially, there are strict deadlines that apply when you are doing a 1031 exchange in terms of identifying the replacement property and closing on the transaction. You got to do those in a 45 and 180-day timetable, and it's very hard to do that right now for obvious reasons. Hard to get around, hard to travel, hard to visit properties, and hard to get into with title companies and do everything that needs to be done to close on a transaction. And so the IRS granted an extension of those deadlines, and they've done so for other types of transactions as well, including contributions to opportunity funds, which has been a big part of the movement in real estate investment in the last couple of years. And then also on the transaction side, there's been additional flexibility given to mortgage-backed securities to modify loans within those securities without violating the tax rules that prohibit mortgage-backed securities from modifying loans. Generally, they're not supposed to do that. They're just supposed to be a conduit for payments. But in certain times like this, where there's severe stress, those servicers need to be given the authority to make loan modifications. And we're fortunate to get some guidance from IRS allowing them to do that. That was done back in the financial crisis as well. Third bucket is employee retention incentives, and I'd add to this, well, there's a $5,000 credit for businesses that retain employees despite a significant drop in revenue or closure or suspension of activities caused by COVID-19. And I'd add to that, there's also new tax credits for family and sick leave. Just a few on next, so that's kind of what's been done to date. Just a few observations here. Tax policies can pretty effective in delivering liquidity to individuals. It's not an ideal mechanism for businesses, and that's why they've had to come up with really creative things like allowing people to carry back losses and amend past tax returns. Otherwise, anything that gets done is really going to have more of an impact in 2021 when taxes end up getting filed. So it's kind of hard to do a lot through the tax code to help businesses when you're dealing with kind of a cash crunch and cash flow and liquidity challenges, but they're doing what they can. I would say rebate checks and tax deferrals combined with unemployment benefits are definitely helping renters and homeowners right now meet their obligations. So those payments are certainly flowing up in that way, help particularly on the renter or homeowner individual side and helping them meet their obligations. That retroactive relief in the CARES Act has helped real estate for the reasons I mentioned. Treasury, on the transactions, they're really seeking to remove the friction associated with some of these strict deadlines. I would say, kind of going forward, the president has definitely telegraphed in the Treasury that they would like to see more of these rebate checks go out to families and individuals. The president has made no secret of the fact that he'd like to see a payroll tax holiday altogether. So not just a deferral of payroll taxes by businesses, but a complete holiday of payroll taxes. I think he's asked for that for the rest of the year. I would say tax policy is going to be a bigger part going forward. If we do have a big phase 4, phase 5, or whatever we want to call it, as the activity shifts from cash flow relief to stimulus, tax policy is always a big part of kind of spurring activity that would not otherwise occur. So I would expect that the tax proposals will be a big part of kind of the next chapter of the legislative response here. Kind of lastly, just some of the real estate issues and priorities going forward for us. I think at the top of that list, you got to put the tax consequences associated with debt restructurings and workouts. Cancellation of indebtedness income is a big issue that arises anytime you have parties that have already entered into a debt or loan or financial agreement. They're coming back to the table, working out changes to those to that loan, and there's a transfer of value from one party to the other. Generally, that's going to generate taxable income for whoever is getting the tax forgiveness. But that's exactly the type of thing we want to occur right now to help everyone get back on track in terms of being able to keep their employees employed, pay their bills, pay their financial obligations. If there's going to need to be debt workouts and restructurings, the tax code shouldn't be in the way there. So we really want to get that addressed, and that's really at the top of the list of things we're dealing with. There was COD income relief during the financial crisis. It was in the form of a deferral. So that's one option we're looking at. Another option is to have an exclusion of that income altogether, and then you have some adjustments to other tax attributes that occur in conjunction with that. So we'll have to see, obviously, how that plays out. That COD, cancellation of debt income relief, has already been provided through the big SBA payment protection program. Any borrower who has a forgiven loan doesn't have to treat that loan forgiveness as income. And so we're essentially trying to get similar type relief on the private sector negotiated loan forgiveness side of affairs. Other two big ones are unpaid rent. So what happens when when a landlord has a tenant who is unable or doesn't make rent payments? Generally speaking, that landlord is still accruing that rent as taxable income, and they may not be able to reverse that income until down the road when that debt is declared a bad debt for tax purposes. Well, those dates don't line up very well. So we want to make sure people aren't being adversely affected by having to recognize income when no income's actually coming in. That's a big item for real estate. And the third is lease modifications, and this is kind of related here as well. So we assume and we are expecting to see a significant amount of landlords renegotiating leases with tenants because tenants are no longer generating the same kind of income, and so they're going to come back to the table and need relief on the lease side of things. And when you modify the lease, that can generate income for the parties, and we just want to make sure that if there's a deferral of rent or there's backloaded rent or that there's not accrual of income earlier than there should be as a result of the lease modification. So that's a big tax issue. As Greg, I think you noted, probably not going to read about that on the cover of the New York Times, but when it comes to the flow of income for a real estate business, these three areas, debt restructuring, unpaid rent, lease modifications, are really critical to kind of bottom line financial outcomes for the real estate business. The other three items I don't need to, I'll maybe leave and we can address those if there's questions. There's a number of REIT-specific issues that are interesting, and we actually got some relief on one of these yesterday, very positive, which is that REITs are now going to be able to make distributions that are a larger percentage in the form of stock as opposed to cash. They can distribute for the remainder of the year distributions are up to 90% stock as opposed to just 80% stock and 20% cash. So that's a positive thing, and I know that was a big priority for NAREIT. We also want to allow REITs to take more of an equity interest in their tenants, and they're currently precluded from doing that. And that's part of the way that we're going to be able to save a lot of these businesses, and landlords are interested in doing that. So I'll stop there. I'm happy to address any questions. I will say if anyone's particularly interested in these tax topics, we did do a longer interview that is on the Real Estate Roundtable's YouTube channel. I'm sure if you just go on YouTube and search for Real Estate Roundtable, you could probably find that. But we did a kind of extensive, deeper dive into the tax changes that have been made thus far during the COVID crisis and some of the priorities going forward for the industry.
All right, thanks very much, Ryan. And I can confirm that if you go on YouTube and search for Real Estate Roundtable, you will find that video because I did that this morning. Let me ask you a question, Ryan. In particular about debt restructurings. I know surveys we've done. The last one we did was April 15th, showed almost half of our members had been in discussions with lenders about restructuring debt, and at that point, April 15th, about 10% had already restructured debt in some way. Under current policy, I know you're looking to get things changed, but under current policy, are there certain types of restructurings that do or do not trigger taxable income for borrowers? In other words, are there certain ways that they should be trying to set up restructurings to avoid taxable income?
Yeah, great question. So this is definitely one where people are going to want to talk to specific advisors on it. But essentially, the line where you cross over into a taxable event is when it's deemed to be a significant modification. And generally speaking, if you are just deferring rent, I think for, like up to 2 years, but are not generally changing payment terms or interest rates, you're not going to run into the issue of being a significant modification. However, once you start getting into larger terms changes than that are more than just a deferral or temporary forbearance, and you're getting into the forgiveness category or significant changes in payment terms, then you're going to be in much more likely to be generating a taxable event for the parties.
Great, thanks. So with the time we have left, we only have a few minutes left. Let's turn to sort of a more general Q&A session here and take some of the questions that have come in from the audience. One question that came in, something that came to my mind as well. I mean, there's been some talk from some quarters about rent holidays or rent strikes or some type of cancellation of rent for a few months. From a policy perspective, and this goes out to anyone who wants to comment on this, I mean, is this gaining any traction at all in Washington? Is there a possibility of something like this taking place?
This is Dwayne. Maybe I can chime in, and then I know Chip and Ryan will supplement. There seems to be a fair amount of consideration, although we've seen nothing yet, in terms of a legislative response to deal with residential renters and providing residential renters with assistance to meet their rent payments, as well as some greater assistance to residential landlords, single family and multifamily, to forbear on mortgage payments for a period of time. We at the Roundtable are also doing what we can to drum up interest to make sure that there should likewise be assistance on the commercial and business tenant side of the equation. It would appear, for example, that based on the data that we're getting from April rent collections, residential rents collected weren't that far off. They were not 100% in at least nationally, but on the business side, certainly rent collections from retail, are way down, restaurants pretty down, and office maybe not down as much. So we're trying to inform the Hill that, you know, no landlord wants to evict their tenant right now, whether that's from a residential perspective or a business perspective. We're under mandates, certainly at the federal level with regard to residential tenants, that, you know, there are eviction protections. And on the business side, a number of key markets have commercial business tenant rent eviction protections. But we need to holistically address the issue for both residential and business. So it is very much our focus as part of phase 4, whatever that looks like, to get some kind of program that would be available both for residential tenants and business tenants that would in some way assist them to pay their rent. The point that we have been driving home is that you can protect a tenant from eviction, which is critical, but that does not relieve the underlying obligation that is contracted to pay a rent. And as we are looking toward longer-term recovery to come out of this crisis, a business that wants to get back up and running will have a much difficult time getting back to normal if it is saddled with past due and owing legacy rent that it has to go back and pay. So we need to do what we can to help those businesses up and running to achieve that objective. I'm sure Chip and Ryan would want to add something on that point, but thanks for the question. It's certainly on point.
Yeah, and I'll just follow on to that eloquent answer there, Dwayne. You know, I think it's important in the cases too where we're seeing these, you know, rent strikes and that sort of thing. We've been very focused on trying to restore the rent obligation chain in a number of different ways. But you know, aside from, I think a lot of people without rental income, you know, a lot of these actions would disproportionately impact smaller landlords, and importantly, it also really hurts a city's property tax collections by sending buildings into foreclosure. So it affects municipal workers, you know, teachers, police, firefighters. So there's a lot of destructive aspects to this. In terms of efforts to try to sort of reconnect the chain, there's some legislation that's being discussed to supplement rents, and there are a number of other ideas floating around about potential funds and or liquidity measures that could help with rental payments, but these are all in very preliminary discussions at this point.
All right, thanks very much. Well, we have 1 minute left. I'll apologize now for not getting to all the questions that have been submitted. We'll try to follow up offline with some of the questions, but with 1 minute remaining, gentlemen, I want to ask a question that's been, I think, getting a lot of play in Washington, which is the idea of liability protections. I think there's a Wall Street Journal headline about it this morning. Presumably, this might include landlords as well, which I think could be important. You know, given people, you know, in retail and office are struggling with exactly how to safely reopen their properties. So just in sort of, you know, 30 seconds or less, is this a possibility to come in a phase 4 bill?
Well, this is something that our working group on building reentry has been discussing. I think it's a very important issue. There's been some discussion about potential legislative fixes. I suspect that is not going to be an easy fix. I know Dwayne has been very helpful in providing light on this issue. Dwayne, maybe you want to say a few words.
Yeah, sure. You know, as a policy matter, you know, the issues that have generally been discussed is what kinds of liability shields might legislatively be put in place by Congress to protect businesses. You know, historically, liability shields that, for example, might limit a business from tort liability for personal injury. They're highly controversial on the Hill. The issue usually breaks down along party lines. Democrats might hear from some of their typical constituencies, for example, unions and trial lawyers, that they are opposed to federal liability shields, whereas Republicans might generally be in favor of some of those issues. I'm speaking in very broad general terms here. But nonetheless, we have been recommending to our members that, consult with your lawyers in terms of what possible liabilities there are here. If we're talking about economic damages, for example, that might theoretically flow from breach of lease or breach of contract, that those would be assessed by the terms of what the contract were and what they stated. So, for example, if a tenant were perhaps denied entry to a building for not wearing a face mask or because they registered a high temperature, and that tenant claimed a loss of business, the scope of analyzing that question would derive from contractual obligations, and that would be different than theoretical physical damages that might arise from someone claiming that they've caught or contracted the virus in a given building, which would be governed by a traditional tort analysis. Did the building owner, in theory, was it subject to a legal duty of care? Did it violate it? And did that violation proximately cause injuries? So the constructs in which to view liability would be a typical contract or tort claim, we think, should any of these arise. Whether or not Congress or a state legislature limits liability in these areas is something that is going to be very hotly debated in Phase 4, and I'm sure in a number of state houses.
Well, listen, gentlemen, an hour goes by awfully quickly when you've got so much to talk about, so we are unfortunately out of time. So I want to just quickly thank everyone for tuning in today. Also thank all three of our esteemed panelists for joining us, and a special thank you for Dwayne for joining us on his birthday. And with that, I will let everyone get back to their day. Thanks again, and everyone, please stay healthy and stay safe.